Hi there, and welcome to this Funds Network Pensions Technical video where we're taking a look at defined benefit transfer advice, when is it required, what are the regulatory timescales, and what will the trustees be looking for confirmation of. Where a member of an occupational pension scheme has requested a cash equivalent transfer value quotation in respect of the safeguarded benefits within their scheme, with a view to transferring the flexible benefits under another pension scheme, then if that CETV exceeds £30,000, the trustees have an obligation to ensure that the member has received appropriate independent advice. The terms safeguarded benefits and flexible benefits are two new concepts that were introduced by the Pension Scheme Act 2015 to describe benefit categories within a scheme. Flexible benefits are money purchase benefits, cash balance benefits, and any benefit which is calculated by reference to an amount available for the provision of benefits to or in respect of the member. Safeguarded benefits are benefits that are neither money purchase nor cash balance. Generally, benefits will be safeguarded if an amount of pension income is secured, or if the terms of the contract or policy include a guarantee about an amount of pension income or a rate of conversion into an income. Typically, this means defined benefits, guaranteed pensions including guaranteed minimum pensions, GMPs, and guaranteed annuity rates, GARs. However, whether a benefit type is considered to fall within the definition of safeguarded benefits is a matter for the trustees or manager of the pension scheme to determine. Where a member who has safeguarded benefits with a CETV in excess of £30,000 requests a transfer value quotation, then, before any transfer is actually made, the member will need to take appropriate independent advice. The Department for Work and Pensions sets a statutory timeline for defined benefit pension transfers. The first step in the statutory timeline is that trustees must notify the member of any need to take appropriate independent advice within 1 month of receiving the initial request for a transfer value. If the £30,000 exemption does apply, members must be informed that there is no requirement for the trustees to check that the member has received appropriate independent advice before they carry out the transfer. The second step is the guarantee date, which is the date the CETV is calculated, must be within 3 months of the date of the member's transfer request. The third step, a statement of entitlement which contains the CETV, is sent to the member within 10 days of the guarantee date. The fourth step, the member must confirm their wish to transfer in writing within 3 months of the guarantee date. The fifth step, the advisor's confirmation that the member has received appropriate independent advice must be submitted to the scheme trustees within 3 months from the day on which the statement of entitlement was provided to the member. And the sixth step in the statutory timeline is that the trustees must have all the necessary documentation and check where necessary that appropriate independent advice has been received by the member. The transfer must then occur within 6 months of the guarantee date. Trustees have no responsibility to require members to follow the financial advice they receive. They do, however, have to exercise due diligence in checking both that the financial advisor is appropriately authorised and that the receiving scheme is not a vehicle for pension liberation, but rather is a registered pension scheme. This means that before carrying out a transfer, the trustees will require the advisor to provide written confirmation addressed to the member which contains the following information. The advice which has been provided is specific to the type of transaction proposed by the member or survivor. The advisor has the required Part 4A permission under the Financial Services and Markets Act 2000 to provide advice on the transfer of safeguarded benefits. The FCA reference number of the company or business in which the advisor works. The name of the member or survivor that was given the advice and the scheme in which they hold safeguarded benefits to which the advice applies. The trustees must also check that the advisor has the correct permissions to carry on the regulated activity. This can be done by checking the Financial Services Register and confirming the firm's regulatory permissions. Where all the trustee requirements are met, they then have 6 months from the guarantee date, which is the date of calculation of the CETV, in which to pay the transfer value to the selected arrangement. Where they have good reason, they can apply to the pensions regulator for an extension to this period. Otherwise, failure to comply will result in fines for the trustees and compensation for the member. Further details of the pensions regulator's regulatory guidance on defined benefit to defined contribution transfers can be found on the link on the screen. Thank you for watching.